that we don't carry any containers, nor do we carry any liquid cargoes. All we carry are dry bulk commodities, and in the dry bulk sector, the majority of our ships are in the small handy size space, though we also have a couple of Supramaxes with us. This is a snapshot view of the company. It shows you what the fleet structure was like at the beginning of last year, what was it like at the end of last year, and what it's like at the end of the second quarter. So as you can see, the gap between the insured value of the fleet, which is basically the market value, and the book value is narrowing as values of second-hand ships continue to come down. The other thing to notice is that the average age of the fleet is getting younger, and the average size is going up steadily. This is a long view of the Baltic Dry Index. It shows you how the index has been impacted by China coming of age at the turn of the century, and what the freight markets were like before that. As can be seen, 2011 and 12 have been so far quite difficult, with the BDI approaching the lows that were there last in the mid-1980s. If you look at it in average BDI terms, then you can see that 2012 at just 943 points resembles what the index was like in the mid-1980s when we had our last very big recession in shipping. The real difference between then and now is that operating costs today are approximately 4 to 5 times higher than what they were in the mid-1980s, yet the income stream or the earnings per day per ship resembles exactly what was going on in the mid-1980s. So this time around, the pain being felt by ship owners is very, very high. If you look at the slide that I have before you and look at the extreme last column, it shows you the breakdown of the main dry bulk commodities that drive the Baltic Dry Index. And as you can see from that, iron ore is roughly 31% of the market share. Coal, thermal and coking coal put together is another 28%. Grains are about 10%, and other minor bulks are about 30%. So that is the breakdown of the demand side of the equation. If you look at the Baltic Dry Index in terms of seasonality, in general, in the months of July, August and September, the BDI would come down. And the reason for that was industrialized countries, which were mainly located in the northern hemisphere, would go on holidays during this period of time, and therefore industrial commodities or raw materials would slow down coming into their countries during the months of June, July, and only pick up in September, October. The other reason why the seasonality is impacted is because grain movements actually come to a halt during this period of time, as the northern hemisphere grain export season only starts in October, whilst the southern hemisphere grain season completes around June. So July, August and September, generally there is not much of grain. And if you remember the last slide, grain was about 10% of the market share. And if you remember that iron ore was 31% and coal put together was 28%. So really all these commodities slow down during these 3 months of the year. But if you were to break down this time horizon for the BDI and look at it as pre the turn of the century and post the turn of the century, then this is what you see. You can see the blue line, which is the period between 1985 and 1999. Here you can see quite clearly the very large impact the very large seasonal impact that used to be there when the Western world or the Northern Hemisphere was in full flow and the economic activities were pretty high. And post that, when you look at post 2000 and look at the pink line, you can see clearly that during China's evolution as the manufacturing capital of the world, the impact during June, July and August is limited to grain movements and not to industrial commodities. But if you look at the month of February, when China slows down for their Chinese New Year celebrations, you can see a very clear, short, sharp drop and a very clear, quick pickup, because unlike the Western world, China takes a break for roughly about 2 weeks, as against the Western world of taking 2 months off. So the seasonality now is that, generally speaking, February will be a very weak month in the BDI. And the months of July, August and September will be weaker, but not as weak as they used to be. So coming to the supply side analysis. If you look at the supply side and see what's been going on, first of all, you can see that we now have more than 10,000 ships in the world in the dry bulk fleet. The average age has come down to just 11 years. The average size per ship is now at the 65,000 ton level, and the total deadweight tons as of the 30th of June was 665 million tons. But what is even more interesting is that if you look at the changes that have taken place just in the first half of this year, you would see that overall, on a deadweight ton basis, there was a 6.91% increase. But if you look at the individual sizes, you would see that in our sector, that is a small handy size sector, there was an actual shrinkage of 2.71%, whilst in the Cape size sector, which is the largest sector, you can see a 10% increase. So you can see what's happening in terms of the supply side in the various sectors on this particular slide. Now, what is still to come? In the balance half of this year, we have another 11% of ships on order, or 74 million deadweight tons. Then there is another 62 million deadweight tons, or 9.3% still to come in 2013, and a much smaller amount of 19 million tons contracted for 2014, and thereafter it's almost zero. Now, if we were to look at the way the fleet has grown over the last few years, then you would see that, for example, in 2009, you ended the year with 479 million deadweight tons of ships, which was a net increase of 9.2% over the previous year's closing. And this 9.2% came through the 73.16 million tons that were on order for that year, less the slippage of 41% that took place that year, or 29.36 million tons, less the scrapping that took place that year of 3.32 million tons, and then you had the 40.48 million tons net increase that took place during that year, which amounted to the 9.2%. So if you just focus on the last row, you can see that the net growth in tonnage in 2009 at 40 million tons went up the next year to almost double at 76 million tons, and then has stayed pretty high in 2011 at 68 million tons. Now, if we were to apply a 30% slippage to the balance of ships that have still to come in 2011 and use a scrapping figure of 40 million tons, which is quite possible based on what's happened in the first half of this year, then you would see that the net increase for 2012 would be 58 million tons, and you can see that the big mountain of supply, the peak of that has been crossed, and now we will see supply numbers coming down as we go forward. So applying the same principles of 30% slippage and 40 million tons of scrapping, the net growth for 2013 will just be a marginal